The bank is making an application to seek exempt status for some of your fund management units as well as your units which engage in principal trading. So it is a requirement under the Singapore Takeover Code that you as fund managers as well as principal traders as well as those who are in the compliance function be familiar with these requirements, as your group compliance will actually have to give a confirmation to the takeover regulator in this regard. So that will essentially be the focus of the next half hour to 40 minutes. I'll be running through, giving you an overview of the exempt status regime, and then we'll talk a little bit more about the regime insofar as it applies to EFMs or exempted fund managers. And then we'll look at EPTs or exempted principal traders. And then we'll also look at the specific obligations or restrictions that will apply depending on whether you have the exemptions or not. Now, I think before I go into details about the exempt status, I just want to sort of set the background or the context in which these exemptions will be relevant for your trading activities. I mean, some of this probably would be quite familiar to you, but in a Singapore context, the Singapore Takeover Code will apply whenever there's a takeover of any company, REIT, or business trust that's a primary listing on a Singapore exchange. The code will also apply to takeovers of certain unlisted companies, namely companies or business trusts with more than 50 shareholders or unit holders and NTA of 5 million or more. So in these situations, the code will apply, and whoever is acting as the offeror and the counterparties of the offeror will be subject to certain dealing restrictions and disclosure obligations under the Takeover Code. I think the key thing from your perspective is really who is considered a concert party of an offeror. So under the Takeover Code, there's essentially two tests. One is a factual test. So whenever there's an arrangement, understanding, or agreement between two parties to work together, to cooperate, to consolidate control of a company, they'll be regarded as acting in concert with each other. So that's a factual test. It depends on the circumstances of each case. But I think from your perspective, the key thing is more about the second test, which is under the Takeover Code, there are various categories of persons or entities who are automatically presumed to be acting in concert with each other. And in the context of OCBC, whenever OCBC acts as the financial advisor to an offeror or to the target company, they're going to be regarded to be acting in concert with the offeror and the target company. And because your corporate finance entity or business unit is going to be deemed to be acting in concert with the offeror, this sort of implicates the entire OCBC group, in that the entire OCBC group will also be treated as acting in concert with the offeror, unless you fall within the exemptions that we're going to talk about. Now, if you do not have the benefit of the exemptions, there will be various restrictions or disclosure obligations that will apply to any dealing by a concert party. So I just sort of highlighted some of the key ones here. So you have Rule 11, which sets out restrictions in dealings during the offer period and before the offer period. But I think one of the key restriction here is the fact that a concert party cannot sell shares in the target company at any time during the offer period, except in very limited circumstances. So obviously, if you're conducting fund management activities or principal trading activities, if this rule applies wholesale, it actually means you can't do any sale of the target shares during this period. Then you have Rule 14, which is the mandatory takeover rules. And 14.3 is a minimum price rule, which means that for the offeror, whenever he's structuring a takeover, the offer price that he offers, must be no less than the highest price paid by the offeror and concert parties in the 6 months leading up to the offer announcement and during the offer period. So again, from your perspective, as part of OCBC Group, if OCBC is acting as a financial advisor, if you buy at a particular price, you are effectively, if you buy at a particular price during the relevant period, then you're sort of setting the floor price for the offeror. This also applies for voluntary offers. The only difference is that for voluntary offers, the relevant period is 3 months leading up to the offer announcement and then during the offer period. And then you also have Rules 17, which sets out certain circumstances in which a cash offer is mandatory or a securities offer is mandatory. And again, when we talk about when these rules are triggered, the reference is always to the dealings of the offeror and concert parties. So long as OCBC is part of the concert party group, your dealings in the market in the target company shares could affect the actions of the offeror in terms of whether he has to make a cash offer or securities offer. And then you have Rule 21, which is usually the rule that an offeror is most concerned about, which essentially sets out that if you buy at above the offer price during an offer period, the offeror will be obliged to raise his offer price to match that highest price that you paid. So, for the offeror, he's typically in control of whether he buys or sells shares. His concern will be his concert parties, and to the extent that, again, OCBC is part of the concert party group, and then in theory, the actions of OCBC entity conducting fund management, buying at above offer price, could prejudice the offeror in that he will be obliged to raise the offer price. Now, I'm going to go into this in more detail, but if you have the benefit of the exemptions that the bank is applying for, then essentially you will not be subject to the restriction on there being no sales. Your actions will also not have any impact on the minimum price that the offeror has to offer in his takeover. And your actions will not also prejudice the offeror in terms of having to revise his offer price just because you buy at a higher price. But you will still be subject to disclosure obligations under the Takeover Code, and we'll go into this in a little bit more detail. Now, for the exempt status regime, I'll just give you a quick overview. This was actually only introduced in May of last year. And for those of you who have been operating in the Hong Kong market, it may be something you're familiar with because the exempt status regime substantially follows the Hong Kong model, which in turn also substantially follows what's practiced in the UK. So I think there's a recognition that there are certain type of dealing activities that are carried out by by a financial advisor who's part of a larger financial institution group that should be because of your China walls and your China wall policies, are effectively separated from the corporate finance activities. So the takeover regulators in these jurisdictions, including Singapore, are permitted to exempt certain types of trading activities from the ambit of the Takeover Code. I won't go into the details of the application process because that's really something for your legal and compliance to handle. But I think the point to note is that when we get exempt status, it applies for the calendar year, so it has to be renewed on an annual basis. So let's say the bank puts in an application this year and gets it, then come next year, the bank will have to seek a renewal, and the bank will actually have to give fresh confirmations that that its fund managers and traders are familiar with the requirements of the code. So unfortunately, you might have to go through another session as a refresher of these rules. So now, in terms of who can benefit from these exemptions, I think you probably can guess now. It's we've talked about it, which is the fund managers and principal traders who are connected to a financial advisor solely by virtue of being part of the group. You're all here because you're part of entities or business units which are within the OCBC group. And when we talk about OCBC group, it's not just the bank itself. It includes Great Eastern, includes Bank of Singapore. I'll now go into the exempt status regime for EFMs, exempted fund managers. Now, a fund manager is defined in the Takeover Code as one who manages investment accounts on a discretionary basis. So to the extent that you get exempt status, it's going to apply to all discretionary dealings in client funds which are managed by the EFM. This is a bit unlike the regime for EPTs, because for EPTs, which you'll soon see, the exemption actually applies for specific types of trading activities rather than applying wholesale to all sorts of principal trading. Now, for EFM, I think there may be situations where part of the capital or part of the funds which are being managed by the EFM is initially seeded by the EFM or by the bank or by the group as a whole. So to the extent the group contributes any funds to the fund, contribute any monies to the funds which are being managed by the EFM, that portion of the funds is considered proprietary and will be treated as startup capital in the context of the EFM exemption. This has implication in terms of whether the exempt status still applies. So if the startup capital represents less than 10%, then the exempt status applies wholesale. If the startup capital represents 10% or more, but less than 90%, you still have the benefit of exempt status, but there are certain conditions that have to be met. So one is that the EFM must not carry out any dealing for the purpose of assisting the offeror or the target company. The second condition is that if the offer or the takeover is structured as a tender offer or general offer, the EFM will not be able to tender shares in acceptance of the offer in respect of the portion that's represented by the startup capital until the offer goes unconditional. And then during the offer period, the EFM cannot exercise any voting rights attached to the shares which sort of represents the portion of fund that constitutes startup capital. And in situations where the startup capital represents 90% or more, then the holder fund will lose EFM status, and then that fund will effectively be treated as an EPT and will be subject to the EPT requirements until such time the startup capital portion is reduced to less than 90%. Okay, we'll now go into the disclosure obligations of EFMs. I mean, essentially, there are only two forms of disclosure. One is either a private disclosure that's made to the takeover regulator, and the other is a public disclosure. And when we talk about public disclosure, it's actually in the form of an announcement that's posted on SGXNet. So for EFMs, the general rule is that it's a private disclosure unless the EFM qualifies as or counts as an associate of the offeror. And we will go into that in terms of what an associate means. There's a disclosure timing or deadline for any dealings during the offer period. Essentially, any dealings will have to be reported either privately or publicly by 12 noon the following business day. So I think your compliance will put in place measures that will require you to sort of like collate or report back any dealings that take place during the offer period, so that OCBC as the group is in a position to comply with this disclosure obligation. Now, EFM will be treated as an associate offeror or the target company if it holds 5% or more of the equity share capital of the offeror or of the target company. I think that's the key rule in terms of when you qualify as an associate. And as mentioned earlier, if you qualify as an associate, you have to make a public disclosure. And then to determine whether, in terms of working out whether you hold 5% or more, I mean, the requirement is that the bank will have to aggregate the holdings of all investment accounts managed by the EFM on a discretionary basis, excluding shares which are held elsewhere, so shares which are held by the EPTs or shares which are held on a non-discretionary basis, or other EFMs operating independently within the OCBC group. I suppose this is something probably more for your compliance to determine based on the feedback that you all give in terms of your holdings. A related rule to that is that, I mean, OCBC as a group, to the extent that you hold shares which crosses the MGO thresholds, then potentially, you may have to comply with the mandatory general offer rules. So from the bank perspective or from the group perspective, there's a separate requirement to aggregate all your holdings throughout the group, whether it's EFM or EPTs, whether it's discretionary, or rather throughout the group in terms of whether it's an EPT or EFM, excluding non-discretionary clients, just to determine whether you're in danger of crossing any of the MGO thresholds. But I think in most cases, this should be a less likely occurrence. Again, the approach taken here for the disclosure requirements or the aggregation rules is similar to what is practiced in Hong Kong. Now, I'm not going to go into this in detail in terms of the form of the disclosure, but essentially in the takeover code, they set out very specific requirements as to what has to be covered in a private disclosure and what has to be covered in a public disclosure. And we'll be working with the bank to sort of develop standard templates, which I assume that you all will just fill out, without having to worry whether you're meeting all the specific disclosure requirements. I think this is a separate point in terms of, so we talk about having to make disclosures whenever you make a dealing during the offer period by 12 noon the following day. We also talk about aggregating the shareholdings to determine whether you count as associate and whether you might cross the MGO thresholds. There's a separate disclosure requirement, which is that whenever a takeover is announced, by 5 p.m. the next trading day, the bank as a group is required to disclose its aggregate holdings on a private basis to the SIC. So I guess this simply means that once a deal is announced, the bank will be reaching out to all the relevant entities and persons to collate the holdings, which it will have to report by 5 p.m. the next dealing day. I'll now just touch very briefly on situations where the EFM status may fall away. Now, you get the benefit of the exempt status unless you fall into one of these situations. So one situation is where OCBC Group itself is undertaking the takeover. So obviously, where OCBC is the one making the takeover or the subject of the takeover, then you will not be able to claim exempt status. The second category is where the EFM is a concert party of the offeror or the target company, other than by reason of being connected to the financial advisor. So if for some reason you are specifically engaged by the offeror to carry out certain dealing activities, and you have a concert party relationship by virtue of that, then you will not have the benefit of the exempt status. And then the third situation where you might lose EFM status is where obviously there's a breach of the confirmations which are given to the takeover regulator, the SIC. Essentially, when we talk about the confirmations which are being given by the OCBC Group, I mean, I think there are essentially two key confirmations that are being given. One is that there are China Wall's policies and processes in place, and that they are being followed within the group that separates the corporate finance entity from the rest of the trading activities. Then the second confirmation is that the relevant persons, the traders, the fund managers, are familiar with the requirements of the takeover code. So to the extent that there's any breach of these confirmations, then potentially the exempt status could fall away. And we already touched upon the startup capital, where the exempt status could fall away if the startup capital represents 90% or more of the fund in question. I'll now go into the exempt status for EPTs. I guess the first question is, who is a principal trader for purposes of takeover code? So a principal trader is one who is trading as a principal in securities, I suppose specific instruments, for the purpose of derivative arbitrage or hedging activities. So if you look at this definition, it gives out specific categories here, or specific activities. So they talk about closing out existing derivatives, delta hedging in respect of existing derivatives, index-related product or tracker fund arbitrage, or other activities agreed to by the SIC. So if you are conducting any trading activity that falls within these specific categories, then you can have the benefit of the exemption. Right. I think the question that a lot of people would typically have is, what other similar activities would be agreed to by the SIC? I mean, obviously there will be specific case-by-case situations or instruments that we might clear with the SIC. But the code actually gives guidance on some general categories of trading activities that are usually seen in the market and which the takeover regulator recognizes as being eligible for the exemption. So you have agency trades, client facilitation trades, market making and liquidity providing activities, ETFs, trading in ETFs products or index-related products, and securities borrowing and lending. I'm going to go into more detail for each of these activities. So for agency trades, I mean, this covers a situation where dealing is being carried out by the EPT on behalf of non-discretionary investment clients, pursuant to their instructions. So essentially, your client is telling you as the EPT to buy or sell securities, but it's still, it's considered agency trade as compared to a brokerage trade, which is the next bullet point, because the EPT is still contracting in a principal basis vis-a-vis the counterparties. So if you are conducting agency trades, you can have the benefit of the exemptions. For brokerage trades, which would be situations like OCBC securities, where the EPT trades as a broker for investment clients and is the investment client that acts as the principal, then brokerage trades are essentially not covered by any of this, in that they are not even subject to the dealing restrictions under the takeover code. So the broker is free to carry on dealings without being subject to these restrictions. Then the next category is client facilitation trades. These are trades where the EPT takes on a temporary proprietary position to essentially facilitate client activities. So there are certain conditions that have to be met before this can qualify as a client facilitation trade. There are essentially three conditions. One is that the dealings must come about because of an unsolicited client order. So it can't be a situation where you solicit the orders or you make a recommendation to the clients. It is effectively a situation where the client approaches you and tells you that they want to structure this particular trade and they want to do it in this way. The second requirement, which is probably more structural or operational, is that the client facilitation desk should operate separately from OCBC's proprietary trading desk. And then the third requirement is that the proprietary position must be flattened by no later than the next trading morning. So in terms of client facilitation trades, I mean, two possible examples is one where you create what the takeover code refers to as Delta 1 products. I mean, the creation of Delta 1 products and related hedging is a permitted activity, again, provided that the trades arise from unsolicited client instructions or client orders. And then the second requirement is that the hedging must be done on a one-for-one. If there's any hedging done in connection to the Delta 1 products, it's done on a one-for-one basis, and the trader doesn't take any directional position on those trades. A second example of a client facilitation trade is where you trade in convertible bonds which were already existing before the offer period. So those trades are permitted, but again, they must arise from unsolicited client orders, and if there's any proprietary position, it must be flattened by the next trading day. So, dealing in existing convertible bonds, that's permitted. But what's not permitted is basically creating new convertible bonds during the offer period. So to be clear, it's not that it's not permitted, but it's not going to have the benefit of these exemptions. Then the third category of common trading activities by EPTs would be market making. So where OCBC acts as a market maker for certain type of securities and instruments, derivative warrants, callable bull-bear contracts, exchange-traded stock or index options. Again, there are certain conditions. The EPT must be recognized as a designated market maker under the SGX rules. The product must have already been issued before the offer period, and the EPT should not be applying for the designated market maker status during the offer period. And the fourth category is dealings in index-related products and ETFs. So as an EPT, you'll be entitled to deal in pre-existing ETFs and related hedging. You'll be entitled to redeem pre-existing ETFs due to unsolicited requests and disposal of the underlying shares. And you can also create new index tracking ETFs and related hedging, so long as the shares in question, so effectively in this case, it's the target company shares in the basket or index represent less than 1% of the total number of issued shares and less than 20% of the value of the securities in the basket or index. And then the fifth category of permitted trading activities would be stock borrowing and lending activities. So during the offer period, if you unwind SBLs or stock borrowing and lending activities, that's permitted. But if you want to enter into any new stock borrowing and lending activities, the bank will have to get the prior approval of the SIC before it can do this. This is one area where there's a difference between Singapore and Hong Kong. In Hong Kong, entry into new SBLs are permitted during the offer period, whereas in Singapore, this requires the approval of the SIC before it is done. Now, there are certain general conditions that applies to all sort of EPT trades. Basically, there cannot be any dealings for the purpose of assisting the offeror or the target company. And the second condition is that the EPT must not be dealing with the offeror or its counterparties. Then the third condition is, to the extent the EPT holds any shares, the EPT cannot tender those shares in acceptance of the offer until the offer goes unconditional. And then the last condition is that EPT cannot exercise any voting rights attached to these shares during the offer period. And to be clear, when we talk about offer period, it's from the time when the offer or possible offer is announced up to the time the offer closes or lapses. Then now going to the disclosure obligations for EPTs. Similar to EFMs, there are essentially two forms of disclosures. It's either a private disclosure to the SIC or it's a public disclosure via the SGXnet. And the deadline for disclosure is the same as EFMs, in that it must be done by 12 noon the following trading day. I mean, I think in terms of associates, I think the point to note here is EPTs on the face of it will be treated as associates and therefore will comply with the dealing disclosures in the context of Rule 12, or the disclosure requirements in the context of Rule 12. So now then go into when do you make a public disclosure, when do you make a private disclosure. Essentially all dealings on behalf of non-discretionary investment clients, so your agency trades, will be privately disclosed. All dealings as principal where you're taking on a proprietary position, those will be publicly disclosed. I think for your ease of reference, effectively what this means is If you have an agency trade, that's a private disclosure. But just about all other forms of EPT dealings will be a public disclosure. And then any dealings in convertible securities, warrants, options, and derivatives will have to be publicly disclosed, regardless of how many such instruments or securities you hold. This is something I touched upon already. So, I mean, this is more about the aggregation for purposes of the mandatory offer requirement. So it applies the same way to EPTs as it does for EFMs, in that the bank will have to aggregate its total holdings across the bank. And similar to EFMs, the takeover code sets out specific disclosures you have to make, whether it's public and private. And again, we will work with the bank to develop a template. And effectively, you need to just fill out the template, and you don't have to worry specifically whether you're complying those disclosure requirements. This is something I've touched upon already, which is that every time a takeover offer is announced, by 5 p.m. the next trading day, the bank will have to report its aggregate holdings across the board, whether it's EFM and EPTs. So the bank will be collating your holdings or in the target company as at the time of the announcement. And the deadline is the same as for EFMs, which is by 5 p.m. the next trading day. Now, this is a specific requirement that applies for EPTs in terms of disclosures. There's a general requirement on EPTs who deals in the securities on behalf of his clients to effectively remind the clients, to ensure as so far as they're able to, that the clients are aware of the disclosure obligations under the takeover code if the clients themselves are associates of the offeror or the target company. So this situation where the EPTs, you have to comply with your own disclosure requirements. But to the extent you're dealing with a client who happens to be connected to the offeror and the concert parties, they should essentially be reminded that they have to comply with the requirements of the takeover code. Right. Now, there'll be specific situations where the EPT status or exempt status will fall away. It's substantially similar to EFMs. So essentially, if the EPT belongs to the same group as the offeror or the offeree, the status will fall away. So where OCBC Bank is making the takeover offer, or where OCBC Bank or the OCBC group itself is subject to takeover, the exempt status will fall away. Then the second part is where your concert party, other than by reason of being connected to other than by reason of being in the same corporate group as the financial advisor or the corporate finance unit. And then the third situation is where there's a breach or non-compliance of the confirmations given by OCBC Group to the SIC. And then the exempt status could also be suspended if it's discovered that the principal trader carries out any dealings for the purpose of assisting the offeror or the target company, or if the EPT carries out any activities outside the list of permitted activities. I think this is just for your reference. If you want more details as to these rules that we've been talking about. So essentially, you have the Singapore Takeover Code as well. More relevant to you will be the practice statement, which goes in a bit of detail in terms of each of the EFM activities and EPT activities. And I think with that, it brings me to the end of the session. Thanks a lot for your attendance, and I'll be happy to take any questions that you have.